What is the weighted average cost of capital? This represents the average cost of gathering funds for the company. It looks at only the long-term sources. These long-term sources, of course, are bonds, preferred stock, and common equity. Companies choose the relative amounts of each of these different aspects or different types of sources. This is an important aspect of decision making. We need to know what it costs to gather the funds to do our projects. So, real quickly here, if you could stop this video and go to an internet browser and type in the browser, what is the weighted average cost of capital of a company? Pick any company you want, as long as it has as a publicly traded company, we should get an answer. When you get that answer, we'll talk about this later in the course. But what this represents is if the company goes out to get money outside of the corporation, the average cost of that money is the weighted average cost of capital. So if we're doing projects, we only want to do projects that will produce profits in excess of the cost of financing those projects. Well, hopefully you're back from your video or your internet research there. The required return is the same value as the cost of funds. So the required return, the yield to maturity of bonds, is equal to the cost of issuing that debt. So what this means is, if the bank says you must pay 5% on a car loan, of course that is what you have to pay. They are saying they want a return of 5%. So this then is also your cost. How did they develop that 5%? It's through a process of valuation and then working backwards to find out what is the cost or what is the return that can be expected to be paid from certain projects within a corporation. How do we determine the returns of securities? Is very similar, doesn't matter the source. There's a current income piece, there's a capital gains piece. Each piece has different levels of certainty dependent on the type of security. Bonds have a very high level of certainty. You know exactly what the interest payments are. You know exactly when the loan will mature. Everyone has a date, right? A maturity date. So you know the exact amount and dates. For stocks, this is where we end up with some uncertainty, right? Dividends are typically paid quarterly, but companies, number one, don't have to pay a dividend, and they can change the value if they want. In addition, what are the stock prices going to be in the future? Of course, this is really the big uncertainty here. Nobody knows what future stock prices will be. This course is all about value and trying to find the value of a corporation, making decisions that will increase the value of the company. So there is a standard formula to find the value of a firm. Free cash flow, we talked about this variable a couple of seconds ago, is about the predicted cash flows of the firm. The time factor is the prediction of when these cash flows are expected to arrive. And of course, weighted average cost of capital, the third variable here, that's the return that's required for investing in the company. It includes things like risk and inflation. So we have what they refer to in this text as the big picture, right? This is all about value, right? So two factors that we're going to be looking at throughout this course are free cash flows, weighted average cost of capital. What happens to this value if free cash flows increase? If I can find a way to increase free cash flows, what happens to value? And of course, you can see value would increase. What happens if I can find ways to reduce the costs of financing? There's lots of ways that this could happen. Could happen just through the economy. We could have reducing interest rates, etc. But in general, we could just get the company to be less risky. That will reduce the risk of the company, obviously, which then would reduce the costs of financing the projects of the corporation. So reducing weighted average cost of capital will also increase value. I've mentioned that there are many economic events and conditions that might affect interest rates, and this list refers to those things that impact the interest rate itself, right? These are external factors. The first three there certainly are, excuse me, the external factors. And by definition, these are not under the control of managers, right? Managers cannot control Federal Reserve decisions. So, whatever these variables are, it is a part of the process that we as managers cannot control. So, interest, as we know, is the cost of money. In addition to external factors, there are things in management's control that they can influence to reduce the cost of financing and the risk of the firm. We can take on certain projects as opportunities present themselves, right? Op, those production opportunities, right? Those have an impact on the cost of financing. We can try to determine how and when to distribute cash flows to our investors. We can influence the risk of the company by the assets and the management styles that we choose. And the actual factors could be internal, they could be under our control, or they could be out of management's control. So, what is a financial instrument? Again, this is just a short list of short and long term securities, and most of them are probably familiar to us. One that's a little bit different might be commercial paper. It's like a personal loan. It typically doesn't have collateral. It merely requires a signature to finalize the loan, and they are very short term. They could be as short as 2 or 3 days to maybe as much as 180, but they definitely have lifespans that are less than 1 year. So the short term assets above here are what we classify as money market securities. They all have a lifespan of less than 1 year. The long-term instruments listed are what we refer to as capital market securities. By definition, they all have a lifespan of greater than 1 year. What are the different markets that we deal with in finance? Physical markets represent some form or substance, right? Financial assets represents it's a piece of paper that's evidence of an asset. So it's not really something you can necessarily touch, right? You can't touch the assets that it represents. The paper represents that. Spot markets are current markets, today's prices, if you will. Future markets imply pricing for future transactions. The next two slides will demonstrate or talk about the next two types of markets as they have some significance in decision making. We can segment financial markets into what they refer to as primary and secondary markets. Now, there are tertiary and fourth level kinds of markets, much smaller in nature and really not all that important for corporate decision making. But the biggest factor here is that the primary market is where securities are issued for the very first time. And IPO is the example of this. It means an initial public offering. This is the first time the company has ever issued securities to the public. The secondary market is every trade that happens after this initial issuing of the security. So the important takeaway is that the only time a company gets funds from investors is in the primary market. In the secondary market, money changes hands, but only between two investors. The corporation is not impacted. Secondary markets are important though, right? They allow entrepreneurs to reap rewards by selling of their stock, right? They can make new investments. They can improve their standards of living, right? It provides liquidity for the owners of the securities. Imagine if you could buy, let's pick a pretty good company. Assume you could buy stock in P&G. But the rule was you can buy it, but you can never sell it. Nobody would purchase that security if you could never convert it into something that you could use. So again, the biggest points here is it provides liquidity for investors and it is a mechanism to help us create prices. So if we think about trading securities, how can we classify trades themselves? Well, there are two dimensions we can talk about. We can talk about location. Location implies that there are ways we interact, right, with these different formats, right? So face to face versus computer networks. There are some types of trades that you can do that are done with people. You talk to people and they make the trades. The other opportunity then is to do this online where really you're not dealing with a person in making the trades. We can also look at how investors are matched, if you will. How do these uh, suppliers and demanders, right, the people that want to buy stock and the people that want to sell stock, how can we bring them together? Open outcry implies face-to-face trading. Dealers can also create trades, though. They can do this online by matching people up on a computer, right? Think about a retail trade type of an arrangement. There are also what we refer to sometimes as automated trading platforms. These are computerized networks that don't bring any people to the table at all. It's a program that you have attached to your account, say, and that program does all the trading, all the buying, and all the selling is done automatically without human intervention. In the end, any of these orders can be done, I guess, completed one of two ways. A market order is when we buy or sell at the current price as soon as we can. Limit orders place some trigger for a trade to happen. If you want to sell the stock at the price falls below 60, no action is going to take place unless the price actually falls to $60. Now, we can also add a time dimension here. Make this trade, But if the trade doesn't happen by the end of the day, cancel it or keep it open until the trade happens. So that's the end of our first chapter, Intro to Finance.